So it's those tariffs that's caused the sell-off. And our next guest is warning that the sell-off we've seen so far may be a tea party. Well, maybe that's a bad analogy, but you know what I mean, compared to others. William Cohan says shares in companies like the Magnificent Seven have soared on momentum, and those sky-high valuations fall very hard. The M7 now represents around a third of the S&P 500, which means that investors holding index funds are highly exposed to a handful of companies. William Cohan is a former Wall Street banker, founding partner of the news site Puck, exactly the man we need to be talking to at this moment. William, look, first of all, we'll get to what you say so far. The idea of these tariffs coming on Wednesday in some shape or form, wide scale or broad-based, do you think the market has fully priced in yet or not?
You know, Richard, it's hard to say because, when President Trump talks about the tariffs, the market goes down. When he sort of pulls back from talking about the tariffs, or maybe he's going to delay the tariffs, the market goes up. You know, the market went up crazy at the end of the day today, even though the tariffs are supposedly coming on Wednesday. It's really hard to know. One thing that investors do not like is uncertainty.
Right.
And we get a lot of uncertainty with this president. So there's a lot of volatility to go with it.
Now, your article, which has caused a stir, basically makes the point that whatever the self-inflicted wounds of the tariff, the market, it says, quote you, at least partly inflicted by the bone-dry kindling lying around in the market. In other words, the overtly high valuations that had already taken place that were starting to be questioned, to be fair, weren't they? We were starting to see a crack after DeepSeek that suggested that, yes, AI is coming, but it may not come as fast or as profitably as before. But now this kindling has had some lighter fuel put on it.
Absolutely. I mean, first of all, Richard, as you know well, we tend to have financial market corrections in this country once every 20 years or so. We're a good 17, 18 years since the last one, which of course was the 2007, 2008 crisis. So we might have been overdue for one anyway. And then you compound that with the fact that the Magnificent Seven that you alluded to, those stocks have just skyrocketed in recent years. They're now held by regular people in index funds which are sort of 60 to 70% of the holdings. And now since Christmas, when these Magnificent Seven reached their peak, those Magnificent Seven stocks, led mostly by the fall in Tesla, are down 20%. That's bear market correction territory. Right. So that means that a lot of people with money in their index funds who have invested in this Magnificent Seven think they're going to have a great ride up are now experiencing a roller coaster down.
You see, the problem as I read your article, and I sort of shouted at the screen because I was reading online, and I sort of shouted, because you make the valid point that, and I've looked myself, if I look at my 401k and my portfolio, a lot of the funds, they all have the same companies in it. They all have Apple, they all have Nvidia. So essentially you're investing the same money 15 times over. But I shouted at you metaphorically over the breakfast table, but Bill, what the heck did you want us to do? This is where the money was being made when the market was going up. We're told to diversify. We put our money into all these different funds. We did what we were supposed to do.
Oh, Rumpf. So the reason people are investing more and more in index funds are two reasons, Richard. One, they're less costly, the fees are less, and they've outperformed the stock pickers. Right. So it's perfectly logical that people would do that. But index funds are like kind of sedentary. They make their decisions and they stick with them. And that was great when the Magnificent Seven had their rise up. And unfortunately, if you got to take the good with the bad, you got to take the bad with the good. Now, as they're on their way down, and again, particularly Tesla, because Tesla has been way, way overvalued for a very long time. Some of the others in the Magnificent Seven are actually not that overvalued, like Apple and Google and Microsoft. they're high priced, but they're not overvalued like Tesla is. And now, for whatever reason, investors have lost their faith in Tesla. The Magnificent Seven are on the way down. It's hard
All
for
right.
investors and index funds to make that change.
So what do we all do? I mean, we're in this. If you haven't sold and you haven't optioned against it, you're in this now it's basically tighten your seatbelt, tray table in the upright and stowed position, and don't serve hot drinks while we have this turbulence.
Well, that's exactly right. And this is not the first time we've had turbulence. There've been I can't count on my both hands the number of turbulent financial markets we've experienced in the last 20 years. You shouldn't bet against America. That's one thing that I think is safe to say. Plus, if you do sell and get out, and a lot of people are going to want to sell and get out, you have to pay capital gains tax. So the market has to go down like an additional 20-25% for you to overcome the capital gains tax. So to sell is a really big decision. It's very hard for individual investors to hedge. Big hedge funds can hedge. Individual investors have a lot harder time doing that. So you got to take the good with the bad. You got to take the bad with the good.
Right.
And sometimes you just have to hold on for dear life on that roller coaster, Richard, and hope that it goes up again.
We will talk more. I'm grateful, sir. Thank you. Reading your stuff on Puck is always illuminating, exciting, and I'm grateful for you joining us tonight on Quest Means Business, sir. Thank you.